Hi, good afternoon and welcome. I'm Jude Covas, Managing Partner of MCB. We're glad that you can join us for our webinar today on maximizing your PPP loan forgiveness. I'd also like to thank you all for submitting questions in advance. We have attempted to work and incorporate them all into the presentation, or answers into the presentation today, so hopefully we'll take care of most, if not all, of those questions. We also have a Q&A at the end of the presentation, so feel free to submit your questions through the Q&A feature, and we'll collect them and do our best to answer at the end. I'm joined today by three of my partners, Matt Dwyer, Phil Busenitz, and Cindi Park. However, this was truly a team effort in putting this together, so I'd like to thank also one of our other partners, Nimish Sanghavi, and our marketing director, Andrea Ansel, for all their contributions as well. Thank you. So between the four presenters, we have over 100 years of experience advising small and middle market businesses and their owners on an array of tax and accounting and auditing matters. So with that introduction, that being said, let's go ahead and get started. And again, thank you for being with us today. Our agenda, we will cover first pending legislation. We'll look at the PPP loan forgiveness application. We'll discuss what the covered period is and what the alternative payroll covered period is. We'll talk about which payroll costs are eligible and ineligible, eligible non-payroll costs. And we'll also talk about how the forgiveness calculation works and incorporating into that the FTE reduction as well as hourly wage reduction. We'll then share some examples with you. And then there's still numerous unanswered questions, and we'll go through what we see as certain questions that are still unanswered for us. And then we'll open it up for Q&A, as I said a moment ago. So our presentation today is based on what we know as of today. As new guidance gets released, we will continue to send out email blasts as well as blog posts. But likely much of what we're going to present today, there's going to be changes to this. And most notable is that there was a bill that passed the House last week on May 28th, and it passed 417-1, so it had significant bipartisan support. And most notably, it calls for extending the 8-week period, the period in which you pay for your expenses in which you'll gain forgiveness, to extend that to 24 weeks. It also changes the 75-25 rule to 60-40 on the split between payroll and non-payroll costs. It would also push back the deadline for rehiring employees from the end of June to the end of December, and it would change the term from 2 years to 5 years. There's a similar bill in the Senate. The Senate's not quite as generous. They're looking at a 16-week time frame rather than the 24 weeks. But we'll see. We expect something to happen. It may happen this week. It may happen next, but we do expect that would happen. What you should know is whatever happens, it will be for the better. You will likely get a longer period of time to incur costs that would be eligible for forgiveness. So first, the application. The application was issued on May 15th. It's Form 3508. The real guts of the form is Schedule A and the worksheets that associate with Schedule A. MCB has created a forgiveness calculator. We're happy to share that calculator with anybody. People just ask any of your MCB associates, and we're happy to provide it to you. There's a lot of work that was put into it to be able to create it, and it does a really nice job. So we're happy to share. We're happy to assist with doing the calculations for you, with you. Just let us know how we can be of help. There's also a demographic information form. That's optional. You don't have to complete it. There's a list of documentation requirements. That's on page 10 of the 3508. We're not going to get into the documentation requirements today. It's a laundry list of items, and most of them, if not all of them, are rather self-explanatory on page 10. And then the forgiveness application, the lender has 60 days to review it. SBA then has another 90 days to review it. So technically it could be as much as 150 days before your forgiveness is approved after you apply. The application itself, the main takeaways here on the left-hand side of the page, that's the summary sheet, which everything feeds into, Schedule A and such, and ultimately determines the amount of forgiveness that you're asking for. On the right-hand side of the page is the certification that will be signed. Most notable is that you'll be certifying as to how you use the funds and that you use them for the appropriate purposes, and that you're also certifying that there's no false statements within everything that you're providing. Okay, the covered period. So the covered period is 56 days, 8 weeks, and it begins on the day that you received your funds, the day that the lender dispersed the funds, which is basically the same day you received your money. That's important because any costs incurred during that 8 weeks to be eligible for forgiveness, they have to be incurred or paid within that 8-week time frame. And we'll get into it in a moment as to what paid or incurred is, but that's the time frame in which those costs need to be paid or incurred. Alternatively, we have the alternative payroll covered period, the ALT-CP, and it similarly is a 56-day period, 8 weeks, but it begins on the first day of the first pay period after you received your money. Now, who's eligible to use the ALT-CP? It's employers that have a biweekly payroll or more frequent. So if you're doing your payroll semi-monthly or monthly, you would not be eligible for the ALT-CP. If you do it biweekly or more frequently, then you're eligible. And then the one important thing to emphasize here, that if you use the ALT-CP, that is only for purposes of payroll costs and eligible payroll costs for forgiveness. For non-payroll costs, you still use the CP. The covered period is always the period for non-payroll costs. Okay, so paid or incurred. And I should say that for this concept is applicable for both payroll costs and non-payroll costs. Guidance recently came out that it's clear that if you incur a cost prior to your covered period or your alternative covered period, but you pay it in your covered period, that counts. There's an example in one of the IFRs regarding an electricity bill that says the covered period started in June. You have an electric bill for May. It gets paid in June during the covered period, but it was incurred prior to the covered period, and it says it counts. It definitely counts. So costs incurred prior to the covered period, but paid during the covered period, they count. How about prepaying costs? The only guidance that we know black and white is interest. Interest on the loans, and we'll talk about that when we get to the non-payroll costs. Interest, you cannot prepay interest and be able to get forgiveness. But it's silent as to the other types of costs. Utilities, rents, we don't know for sure whether you can prepay for those items. Then there's also a special rule that says if you've incurred the cost during the covered period or the alternative covered period, but it's paid after the covered period, but by the next regular due date or the next regular payroll date for purposes of payroll, then those costs are eligible for forgiveness. So costs incurred during the covered period, but paid in the first cycle after, they're eligible for forgiveness. And as I said a moment ago, these concepts, these principles apply for both payroll and non-payroll. So the laundry list of items that you see on that page, most of those items as to what are payroll costs, most of those were in the original guidance that came out. More recently, though, you see the two italicized items, the bonuses and the hazard pay. That came from a recent IFR, an interim final rule, that said that bonuses count for forgiveness and hazard pay does as well. The two asterisk items, the retirement benefits and the health benefits, a couple things of note there that are important. One, the amount eligible for forgiveness is only the employer's share. the employee's share does not count for forgiveness. It's only the employer's share that counts. Secondly, for self-employed individuals and for partners, when you applied for your loan amount was based on your self-employment income in 2019, either off your Schedule C for a sole proprietor or off your K-1 for a partner. Forgiveness will be based on that same 2019 amount, and we would advise that you pay yourself off that number, off your 19 amount, in order to gain forgiveness for 2000 during the 8-week period to be able to gain forgiveness. But for self-employeds and for partners, the retirement benefits and the group health benefits do not add on top of what your Schedule C or your K-1 was. It's viewed that amount on your Schedule C or on your partner K-1, you use some of those monies to pay your retirement benefit for yourself and paid your group health benefit. So they don't count, they don't get in addition, they're already embedded within your self-employment income. Okay, so what costs are ineligible that you cannot use for payroll costs? The amount of wages for anybody who has wages over 100 grand. And then secondly, for 3 classes of employees, owner employees, namely S Corporation and C Corporation stockholders, as well as self-employed individuals and general partners, if their compensation is greater in 20 than it was in 19, that excess does not count. Other things that are ineligible would be the employer share of FICA, Medicare, and FUTA, as well as any costs that you incurred that you claimed a credit for under the FFCRA. And as we already talked about, the health insurance and the retirement benefits for sole proprietors and partners, that's not an add-on. That does not count either. And then lastly, any cost, payroll costs for someone living abroad, a non-US resident, they do not count. Okay, so let's take a look at an example as to how the covered period would work for payroll costs. And in this example, we're assuming that you got your money on May 1st. The disbursement date was May 1st. So the 8-week period runs from May 1st to June 25th. We further assume that the employer is paying on a bi-weekly basis, and that the first payroll period is April 26th to May 9th. So part of that period is before the covered period, and part of it is within the covered period. It's then paid, at the bottom of the slide, it's paid on 5/14. So it's paid 5 days later. This is a usual kind of format for most employers. So it's paid 5 days later. It's paid within the covered period. All of 14 days of that payroll period are eligible for forgiveness because it was paid in the covered period, even though some of it was incurred prior to the covered period. Then the next 3 pay periods, they all are paid within the covered period, the last one being on June 25th. But then the next pay period, the pay period for June 21st to July 4th, 5 of those days fall within the covered period, but they're paid, that pay period is paid on July 9th. So it's paid outside of the covered period. But again, we have the special rule that says, as long as it's paid in the first pay cycle after the covered period, the days incurred during the covered period, they count. You get forgiveness, it's eligible for forgiveness. So you would get 5 days of that pay period, the 5 days that were incurred during the covered period, you'd get those 5 days. So you get a total of 61 days. You essentially get more than 56 days, more than 8 weeks in this example. The alternative payroll covered period, example for it, similarly, we have the loan date at May 1st, that the money was received on May 1st, but the alternative covered period starts on the first day of the first pay cycle within the covered period. So that's May 10th. Our first payroll that's paid within the covered period, we pay that on May 14th, similar to the prior slide. where we're paying the payroll for the 4/26 to 5/9 payroll, and we're paying it in the covered period. So you get forgiveness for that period, even though all 14 days were prior to the covered period. They were incurred prior to the covered period, but they were paid during the alt-CP. So you get forgiveness for that. Then the next 3, they're all paid, incurred and paid within the covered period, the alt-CP here. And so you get forgiveness for those next 3 as well. Then the last pay period, the period June 21st to July 4th, that is paid after the alt-CP ends. It's paid 5 days later on the 9th of July. So it's paid outside the alt-CP, but it's paid, again, the special rule governs where we're paying for costs incurred during the alt-CP, but it's paid in the first pay cycle after the alt-CP. So you get forgiveness for all of those days because they all were incurred during the alt-CP. And therefore, in this example, you're getting a total of 70 days of forgiveness. Non-payroll costs. What's eligible for non-payroll costs? So the things that are eligible are interest, rent, leases, lease costs, and utilities. For all 3 of those categories, the obligation had to have existed at February 15th, 2020 of this year. So February 15th of this year, the obligation had to be in place. In the case of interest, it's for interest on what they call mortgages, loans that's secured by real or personal property. So in the case of real property would be buildings, land, and such. Personal property would be a car, a copier. So as long as the property secures the debt, then the interest is eligible for forgiveness. As I said earlier, though, no prepayments of interest are permitted. There's an IFR that's specifically stated as such. And then the same special rule applies here, that if you pay, it's for expenses paid in the CP, or if you incurred it and then paid it in the first billing cycle after the CP, you end up getting forgiveness for those as well. We're posing the question, do rent and utility prepayments count? As I said, interest specifically doesn't. They came out and said it doesn't. It's silent on rent and utility, so we're not certain about that. So an example for the non-payroll costs, same fact pattern. The money's received on May 1st, so the CP, the covered period, begins on May 1st and runs to June 25th. In this example, we're using rent as an example, and rent is commonly paid the first day of a month, and the billing cycle is usually a monthly billing cycle corresponding to the calendar month. So in this example, May's rent is paid in May, you get forgiveness. June's rent is paid in June, you get forgiveness. The questions then that are postulated here would then be, what if you pay July's rent before the end of the covered period? Do you get forgiveness for that? Not certain. We're waiting for guidance on that. How about April? April is before the covered period. Probably many businesses were already experiencing an economic downturn, and perhaps many businesses deferred or did not pay their April rent in April. What if you paid it then in May or in June during the covered period? Well, it would count. It's incurred prior to the covered period, but it is paid during the covered period, so it would count for forgiveness. So conceivably, you could get up to 4 months of forgiveness if those fact patterns are part of your fact pattern, that we're allowed to gain forgiveness for a prepayment, don't know yet. And if you delayed paying your June rent and paid it during the covered period, you'd get that month covered as well. So that being said, we're going to move forward to forgiveness calculation, and I'll turn it over to Matt Dwyer. Matt?
Thank you, Jude. Obviously, one of the attractive aspects of this program is the ability to have all or a portion of the loan forgiven. To that end, Small Business Administration has issued guidance. They've put out a number of items, including a form, SBA Form 3508, which runs through the forgiveness calculation. Jude referenced this earlier. It is 11 pages, but it's really made up of three main parts: an actual PPP forgiveness form calculation, an underlying Schedule A, and then a worksheet schedule, a worksheet A, which has tables 1 and 2, and really in that worksheet and then Schedule A is really where the heart of a lot of the calculations, are being made. In running through the forgiveness form at a high level, it's fairly straightforward. You take all of the eligible payroll costs, and as Jude indicated, you're either going for the covered period or the alternative covered period, and you add to that all of your non-payroll costs, which are strictly during the covered period. Once you have all those numbers, you have your base for the forgiveness calculation. The Payroll Protection Program, as the name implies, is looking to keep employees on payroll, and so as an incentive for that, as part of making the program, they have a couple of items that will reduce the amount of this loan that can be forgiven. One of which is if you reduce salaries of employees above a certain amount, that portion of the loan it reduces your forgiveness that you can achieve through the loan. Also, if you reduce your full-time equivalents, and we'll run through the calculation of that, but you take your ratio of the reduction of full-time equivalents to your reference period, and that further reduces the potential loan amount. So once you have your potential loan amount, you look at two other numbers. You look to see whether or not at least 75% of the amount of your potential loan is related to payroll costs. Mechanically, you take your payroll costs that you've determined and you divide by 0.75, and then that ends up being one of the numbers you look at, and you obviously then look at the loan amount. You can't get any more forgiven than the loan amount itself. So you take the lower of the potential forgiveness amount based on the calculations, an amount that assures that 75% of the forgiveness is payroll costs or the loan amount itself. So in going through the calculation, as I said, 75% of forgiveness amount does have to be related to payroll costs. However, as Jude indicated, this is likely to be changed. We don't know exactly what this will get changed to, but legislation is currently there, and it's looking like this will get moved away from that number, and or the period will increase, which will make it easier to achieve that 75% amount. As I indicated, there are two calculations that reduce the forgiveness amount. That would be the reduction of full-time equivalents or reduction in salaries. And there is an overarching safe harbor that you can use for each one of those calculations that we'll discuss. On the full-time equivalents, the important things to take a look at the full-time equivalents, and this is where we start getting into a lot of the calculations. The first thing you have to do is you do have to figure out whether you're using your covered period or alternative covered period. What I think this is going to mean for most people is running back of the envelopes to see what costs are incurred in both, but there are underlying calculations of full-time equivalents, which may mean you have to do full calculations for both items. And you compare those two to the reference period. And the reference period is either last year from February 15th, 2019 to June 30th, 2019, or you could use the date January 1st to February 29th of 2020. There's a third period of time that's available for seasonal employees, but I think 90% of the people are going to fall into one of the first two categories of the reference period. Full-time equivalents, it's important to note, is 40 hours. There was speculation early on that it might be 30, but it is certainly 40. When you calculate the full-time equivalent, you are looking at your average full-time equivalent, and you're calculating it by week, by employee. This is where the calculation gets a little bit more complicated and having to run down and run through it for these different periods to figure out what's the most advantageous periods and reference periods to be using. They do give you a simplified method for determining a full-time equivalent. Somebody who's 40 hours or more can be treated as a whole one full-time equivalent. Somebody less than 40 hours can be 0.5. Again, something else that requires a separate calculation to see what is going to be most beneficial to run through. There are some exceptions to the full-time equivalents, and probably some of our most often asked questions. But the main exceptions here are, first off, if you had an employee that you laid off or left, and you then, or somebody you've laid off, and you have then offered them the job back, and in good faith given them a written offer, and it does have to be written, and they've declined, and we've documented that that's been declined. That employee does not have to be included in this reduction, so you can exclude that employee. The one caveat is that the other thing the employer must do for that to qualify is they must notify the state unemployment agency within 30 days, which would mean that that employee is no longer eligible for unemployment. So that's one aspect of the exceptions that gives employers a little bit of a heartburn, is having to notify the state agency. And we still haven't gotten full guidance as to how that's supposed to be done, but that is one of the aspects. The other three items are that if you've been fired for cause, somebody's voluntarily resigned, or somebody is voluntarily requested for reduction of hours, they don't feel comfortable, they have other things they want to do at home, taking care of kids, whatever the case may be, I would document all those things, but the employee is excluded from our reduction calculation. So those are important exclusions, and they're all documented. All right, the FTE reduction example, and this is straight out of the regulations. It's very basic. Really, the heart of these calculations going into how do you determine a full-time equivalent. But it is important here to make note of what a direct relationship this is that we had 10 full-time equivalents originally in our reference period, and we dropped down in our covered period or alternative covered period to 8 full-time equivalents. So we have a 20% reduction. Well, that's going to result in a 20% reduction of eligible expenses that we can use for forgiveness. So we're going to eat into quite a bit of the forgiveness portion of our potential loan. FTE safe harbor reduction. This is pretty well known that what they did allow for is that if you restored your full-time equivalents back to the level that existed February 15th of this year, and if you do that by June 30th, you don't have to use, or you are exempt from the FTE calculation. You're considered to have fully met the FTEs and don't have to have any sort of pro rata reduction. The caveat here is that you can only use this if you laid people off between that January 15th day and the April 26th. So you have to see a decrease in your employees over that period of time. If you hold on to employees, if you held on to them through the 26th and then laid them off after that date, you can no longer use the safe harbor method. So you'd have to go back and you'd have to actually run the calculations to determine what the reduction would be. The next reduction that we need to take a look at is the salary / hourly wage reduction. So in this calculation, what the guidance is if you've reduced the salary of an employee by more than 25% during the covered period from what it was during the first quarter of 2020. And I should point out that this applies to employees that are making less than $100,000 for 2019. So If you made more than $100,000 for 2019, this doesn't apply. It's for those employees that made less. And in that case, you take a look at what the employee made during the covered period. You take a look to see if it exceeded that 25% base, and if it did, there's a portion of that decrease that goes against your forgiveness. So you'll have to back that out, and we'll show that a little later in the example of the calculation. One thing to point out here is that the portion of the decrease of the salary that relates to a reduction of hours is not included in this calculation, because we've already taken care of that in the full-time equivalent reduction. This is strictly a reduction in the rates of the employees. So I'm going to go through two examples. These examples will tie into the examples that Phil is going to do next. But let me give you a couple of pretty easy and simple examples here just to illustrate what's going on. I know in both the full-time equivalents and the reduction, this is really where the rubber meets the road for a lot of people, and having questions on how it's calculated. There's too many permutations to go through everything. We're certainly happy to help out and answer questions afterwards on these types of items, because I know this is where some of it can get a little tricky. But for employee one, very straightforward. We don't have any sort of reduction in time for this employee. During the first quarter of 2020, they earned $1,000 a week. During the covered period, their salary is reduced to $500 a week. First thing we take a look at is, what's the allowable reduction? Well, we're allowed a 25% reduction in salary before it's counted against the forgiveness reduction. Anything after that, we then have to reduce the amount of potential forgiveness of the loan. So if we have a $250 is our allowable reduction, but we've reduced this person down to $500, so there's $1,000. We took out $250, so we could have allowed them the $250, but we're really paying them $500. That means there's $250 reduction per week. That's in excess of the baseline. So if we do $250 times the 8 weeks, we have to then reduce potential forgiveness for that employee by $2,000. And keep in mind, then, we're doing this for every one of our employees. The second example is employee number two. So employee number two was during the reference period a full-time employee. During the covered period, went down to 80% of those hours. So now we're at 0.8. Same facts occurred. They earned $1,000 per week in the first quarter. They're now down to $500 per week during the covered period. The first $250 is allowable without any sort of reduction in the forgiveness amount. So that's $250. We then have to reduce. We have to take a look at what's the allowable reduction in salary for a reduction in number of hours. And so that would be 20% here, because we went from a full-time to 80%. So we take that 20% times 1,000, so that's $200. So we're allowed another $200 because that's taken care of in the full-time equivalents. So if we take a look at the salary reduction, we take a look at the 1,000, less the 250, which is allowable, less the 200, which is for the reduction in full-time equivalents, and that leaves us to a reduction of $50. That's in excess of the amount that we would otherwise have been allowed to give them, and that's for 8 weeks. And so our forgiveness that's not going to be credited against our loan would be $400 for this particular employee. And safe harbor, again, very similar to the safe harbor that we had under full-time employees. That as long as we restored the salary of the employees to the level it was at February 15th, and we do that by June 30th, we're exempt from this reduction. But we can only do this if we had reduced wages during that February 15th to April 26th. And I know some people, again, had held off and hadn't done anything by that time. Unfortunately, the safe harbor does not apply if the reduction didn't occur during that, or there wasn't a reduction during that period of time. We make the final note here is that this is done for each employee. So these calculations do get to be time consuming. There's a lot that goes into it, but We're now going to go ahead and run into some examples with Phil, and he can show you how this calculation is done with some numbers.
Thank you, Matt. I've got a few examples here that will help show how these different limitations work together on the SBA form. The line numbers that you see on your screen here, these mirror the lines on the SBA form 3508, the loan forgiveness application. In this example, we see that ABC Inc. received a loan of $500,000. Line 1 shows that during the 8-week period, they had payroll costs of $380,000, which is 76% of the loan. Lines 2 through 4 are our non-payroll costs, and keep in mind for all practical purposes, non-payroll costs are grouped together. They're not treated any differently. Interest and lease payments, utilities are all treated the same. So we had $140,000 of non-payroll costs. That's 28% of the loan. We have on line 5 and line 7, there's no reduction for the salary and wage limitation or the full-time equivalency test. So the $520,000 of costs we have goes straight down to line 8, which is our potential forgiveness amount. Line 8, then we compare it to lines 9 and 10. We take the lesser of those 3 numbers, and that's ultimately what is forgiven. So in this case with ABC, the forgiveness amount was limited, of course, to the loan amount, and $500,000 was forgiven. They don't have to repay anything. In the second example, we've got both the salary wage reduction and the FTE reduction. So this slide shows part of the Schedule A worksheet, which is used in completing Form 3508. It shows that XYZ had employees whose pay was reduced by more than 25%, and they were not restored to their Q1 levels by June 30th. So we have a salary wage reduction. And that's the purpose of Table 1, is to compute this reduction. And keep in mind, this is for, it only applies to employees who are paid at an annualized rate of $100,000 or less for every pay period during 2019. So just an example, assume that you pay your employees weekly. You have an hourly employee that earns $40 an hour, but during just 1 week in 2019, they were paid for 50 hours. That's $2,000. If you annualize that, that would be a salary or compensation of $104,000 for the year. So because of that one pay period, they would be excluded from the salary wage reduction calculation, even though they may only have earned $85,000 in 2019. So an employee like that would be counted on Table 2, which we're going to see on the next slide. So here we see both Tables 1 and Table 2. As I mentioned, Table 1 is used to compute the salary wage reduction. That's the blue number on the right-hand side, the $10,000. And Table 2, the data used from both tables, Table 1 and Table 2, are used to compute the FTE reduction as well as the cash compensation component of the payroll costs. And that's the $250,000 that you see down there at the bottom in blue. And the 90% is the FTE reduction on the right-hand side. So as Matt mentioned, employees 1 and 2 are the ones that we just went through in his examples. The yellow column shows what their annualized salary was during the first quarter. The green columns show what the annualized salary was during the covered period. Employee 1 was full-time. They took a 50% pay cut, continued to work full-time. Their weekly wage reduction that counts against forgiveness is $250 or $2,000 for the period. Employee 2, because their hours were cut, they're getting that 0.8 that you see there highlighted, that falls down to the 45 at the bottom and reduces the FTE reduction quotient. So because that reduction in hours is affecting that 90% that you see at the bottom there, that employee does not get as large of a salary wage reduction. You can see it's only $400 there, even though their pay cut was exactly the same as employee 1. So the exercise Matt just went through with employees 1 and with those 2 examples You do that for every employee that is in Table 1, those that had no pay periods during 2019 that were greater than a $100,000 annualized salary. You add all that up, you get the salary wage reduction. In this case, it was $10,000. And that number carries straight to Form 3508, which we'll see on the next slide when we get there. The Table 2 is the employees that did have pay over $100,000 during any single pay period. The purpose of Table 2 is to account for the cash compensation for those employees that didn't fall into Table 1, and also to accumulate their FTE equivalents, their full-time equivalency, and help in the reduction calculation related to that. So if we look at the two FTE columns, we can see we have a total of 50 FTEs during the reference period and only 45 during the covered period. You divide 45 into 50, you get, or 45 by 50, I should say, you get a FTE reduction quotient of 90%. That carries over to the Form 3508, which we'll see shortly. And then we also have $250,000 of total cash compensation from both tables. And this carries to Schedule A. Now, we're not going to take the time to show you Schedule A, but anyhow, there on Schedule A, it will be combined with the other payroll costs, primarily health insurance and retirement benefits, employer-paid health insurance and employer-paid retirement benefits, to arrive at the total payroll costs. So on the next slide, we're going to see how this all comes together. So here we have company XYZ. They got the same $500,000 loan as ABC, but we had to reduce payroll costs to $300,000. And that's $50,000 more than we saw on the previous page because we have the health insurance and the retirement costs in there as well. And I should say we thought we had to reduce the payroll, and we'll come back to that in a minute. Fixed costs for XYZ are the same $140,000 of fixed costs that ABC had. So we go through the form. Our subtotal on line 6 is only $430,000 after the salary wage reduction. We're going to multiply this $430,000 by the FTE reduction quotient of 90%. This gives us $387,000 of potential forgiveness on line 8. We're going to compare that to lines 9 and 10. Since it's the smaller of the three numbers, the actual forgiveness becomes $387,000 out of the $500,000. So you can see that the decision that was made to reduce payroll costs by $80,000 proved costly for XYZ. They saved $80,000 in payroll, but they lost $113,000 in loan forgiveness. So management is obviously going to want to rethink that decision. And the good news is you can look at this, you can project this during the covered period and adjust accordingly if it makes sense. If XYZ is sitting here in the middle of the covered period and they see this is where they're headed, they could perhaps find ways to increase their payroll costs and at no cost or perhaps at a benefit to the company. So this example shows the strong incentives that the program provides to keep people on the payroll and keep them fully employed. In the third example on the next slide, we're going to see how non-payroll costs can help with forgiveness even when they exceed the 25% of the loan amount. So the first two columns on this slide are the examples we just went through for ABC and XYZ. We've added a third column for company 3. It has all the same numbers as XYZ, except that company 3 had $15,000 in interest expense on loans that were secured by business, real, or personal property. While you've probably heard that no more than 25% of the loan can be used for non-payroll costs, the actual rule is that no more than 25% of the forgiveness can be attributable to non-payroll costs. The salary wage reduction and the FTE reduction create an interesting dynamic with respect to this 25% limitation. So XYZ's non-payroll costs in the middle column, they were $140,000. They were 28% of the loan amount. Company 3, by adding another $15,000 of interest expense, increased non-payroll cost to 31% of the loan amount. And this paid off for company 3. When you go through the calculation, you've got the $445,000 multiplied by the FTE reduction quotient. So line 8, our potential forgiveness amount is $400,500. That's 13,500 more than XYZ. It's 90% of the 15,000 of additional costs. So we can see that because of the increased non-payroll costs, the payroll costs that are on line one, the same $300,000, they're now less than 75% of the potential forgiveness amount. So the payroll cost limitation, the 75% limitation on line 10 comes into play. And of course, this ensures that no more than 25% of the forgiveness is attributable to non-payroll costs. And even though in this case, up to 31% of the loan proceeds were used for non-payroll costs, and it helped to reduce what had to be repaid. So the bottom line is the extra non-payroll costs that company 3 have added $13,000 to the amount that can be forgiven. So they only have to repay 100,000 of the loan. We're hoping to get more clarification, as Jude mentioned earlier, on issues like prepayment of costs, particularly non-payroll costs. Rent is an obvious example of somewhere where you might want to take advantage of this if we know that it can be counted. If we do in fact know that prepaid expenses can be counted because they were paid during the covered period, then depending on your situation, it might make sense to go ahead and pay advance rent during the covered period. So these are just 3 examples. They show there are a lot of interesting nuances in the loan forgiveness calculation. We've developed here at MCB a fairly extensive spreadsheet to assist our clients in the process of determining loan forgiveness, and we certainly look forward to working with you in this regard. With that, I'll send it back to Jude to discuss some of the questions that small business owners are still asking.
Thank you, Phil. Okay, so many of you on today's call, I've had numerous conversations with you throughout the last 2 months as PPP guidance has been coming out, and it'll sound familiar, the refrain of, we don't know. We don't know the answer to that. Well, this is in that category. Some things we do know, some things we still don't know. First item there, do bonuses count as cash compensation? As I mentioned earlier, yes, the IFR issued on the 22nd of May, bonuses definitely count. Is the forgiveness taxable income? Now, this is an interesting question because when the CARES Act came out and PPP part of it, Congress specifically said that the forgiveness of the loan is not taxable income. Generally, loan forgiveness results in taxable income. They specifically said it is not taxable income. But then the IRS reminded everybody through an announcement that said, to the extent you use non-taxable proceeds for the expenses that you pay with those non-taxable proceeds, they're not deductible. So that effectively puts you in the same spot that the loan becomes taxable to you if you're not getting a deduction for the expenses used for forgiveness. There's definitely bipartisan support to change this. There's been discussion that they're asking Mnuchin and the Treasury Department to change that and change their ruling on that. If they don't change it, if Treasury doesn't change it, Congress almost certainly will act on this and get that changed. That seems to be the prevailing wisdom, that it will ultimately be deductible. But right now, it's not, as of today. What's the deadline for submitting your 3508, submitting your application for forgiveness? Don't know. It is not specified. The application form itself has an expiration date of October 31st, 2020. As I said earlier, you've got 60 days, lender has 60 days to approve your loan after you apply, and SBA's got another 90 days on top of that to approve the loan. So that's 150 days out after you put in your application, but we don't really know what the exact deadline is. How do closing orders for non-essential businesses affect the calculations? No guidance on that. How about if you're part of an acquisition or a merger? How do your calculations get adjusted for that? No guidance on that. When the application came out, they described as one of the utility items that is eligible for forgiveness is transportation utility cost. What is that? Telephone and internet costs. Again, in the application's guidance, it said that those are eligible for forgiveness. Does that include things like employees' cell phones and paying for their internet connectivity, for an employee's internet connectivity, at their house versus just paying for the internet connection at the office's place, the business's place of work. We're not sure on that. It's silent on these things, so you would seem to infer that they would be eligible since they're not specifically excluded, but we just don't know for sure. Related parties, to the extent you're paying rent or paying interest on a loan to a related party, probably the most typical example would be you have an operating business and you're leasing the space that you operate out of from an LLC that you also own. You pay rent to that LLC. Is that rent an eligible expense? We think so. There's nothing precluding that from being able to be an eligible expense. There's no exclusion for related party transactions, but we don't know for sure, but we would think that that's allowable. Interest, the question here is maybe a little bit esoteric in that the idea being, okay, if you borrowed and bought a building and you bought a building for $1 million and you borrowed $1 million to buy the building, that interest is clearly going to be eligible for forgiveness. But let's say 10 years later, which is now today, you had refinanced that property and took out a $2 million loan, and then you use that excess $1 million to be able to do other things with it. Is the interest on that other $1 million, the refinance proceeds, is that eligible for forgiveness? That would be akin to like the tracing rules that maybe many of you are aware of for income tax purposes. So does that same kind of rule apply here? They're silent on it, we don't know. The restoration date of June 30th, what if your CP or your alt CP period falls outside of that date? What happens then? We're waiting on guidance there. What if you had an expense incurred prior to the CP or the alt CP, but you paid it during? Do you get forgiveness? Yes, that guidance came out. How about prepayments? Prepayments, we're not sure of for rent and utilities. We know for sure that interest, you can't. And then the last question there, and I think I touched upon this a little bit earlier, does the health insurance and the retirement contributions for a shareholder employee, do they count? Shareholder employee being an S corporation or a C corporation shareholder. The guidance seems to be a little bit murky on that as to whether you can count that in addition to the $100,000 cap. You certainly can't for Schedule C, sole proprietors, or for partners going off of K1, but you're not really sure about S corporation and C corporation shareholders. So those are some of the questions that we view as still open-ended. And as I said earlier, as new guidance comes forth, we will be providing that information via email blasts and contacting you personally, as well as through blog updates. So stay tuned. And with that, I imagine we have questions that have come from the audience, and I'll turn it over to Cindy and we can do our best to answer them.
Thank you, Jude. Yes, we do have quite a few questions. We will try to cover as many as we can in the remaining amount of time. So let's get started. First question, our organization pays salaries 2 times a month, the 1st and the 15th, but not bi-weekly. Are we still able to take advantage of the alternative payroll covered period?
You would not be able to, because that is longer than a bi-weekly period, and so the alt CP would not apply to you, I'm afraid.
So what if I pay my payroll once a month? Does that mean that I'll be able to claim forgiveness for 2 payroll periods?
Yes, you should be able to get at least two payroll periods within the 8 weeks, plus whatever accrues. If you pay on the 31st and your covered period ends on the 15th of the next month, you would get to count those 15 days that accrue to the next month. So presumably you could get 2 months and some extra days on top of that.
That's a good example. I agree with you, Phil.
Okay. This one was kind of addressed on the last slide that we had, the unanswered questions. What about rent paid to the owner of our S Corp who's an owner employee? he owns the office space. Would that qualify for forgiveness?
There's nothing precluding that from happening. There's no guidance saying that speaks to related parties being excluded from being able to gain forgiveness for such payments. So we think the answer is yes, that would be eligible for forgiveness.
Another question from a webinar viewer. Our PPP funds hit our bank on May 1st, and our bi-weekly payroll for hourly employees for the previous pay period hit our bank that same day. Does that payroll qualify for forgiveness?
It would, because the incurred, even though the payroll was incurred prior to the covered period, it's being paid during the covered period, starting on the day that you received your funds. So that would be a pay period that counts for forgiveness.
Okay. And then moving on to some questions in regards to non-payroll costs. Do IT support costs under regular monthly agreements qualify for forgiveness?
I don't know if we've addressed this among our group. I think not. Phil and Matt, what's your opinion?
Yeah, I don't, Jude, I don't believe that they do. I don't think they're one of the listed items. I think they have to be included within those items. And so those costs, other office costs, you know, those don't qualify. It's strictly the payroll costs plus the amounts listed. And that's my reading of the guidance at this point.
Phil,
That's my understanding as well. I've read some stuff. Other people are asking, you know, my internet service even, does that count? Or my cloud provider. Certainly the cloud provider does not. I'm not sure about the internet service, if that's a utility or not.
I think the internet is. I think the cloud provider is not.
Yeah.
But you can see there's a little bit of interpretation still going on in this one. What's a utility?
Absolutely. Hopefully that'll be covered in the FAQs if we ever get them.
Yeah, that's a good point, Phil. That was one thing I meant to say, that several of us have been sitting in on the AICPA's weekly town hall meetings on Thursday afternoons, and they've been in touch with the powers to be at the AICPA have been in touch with SBA and Treasury on a regular basis, and it's been said that there's 20 to 30 FAQs that are going to be forthcoming. It's been speculated that they've been delayed because Congress is working towards this liberalization of the 8-week period and the other changes that we mentioned at the beginning. But there are going to be more FAQs coming, but perhaps they've been delayed because of that.
Okay, another non-payroll expense question. Are you saying that amounts paid for leased equipment, such as vehicles, copiers, etc., can qualify as a non-payroll expense eligible for forgiveness?
Yes, as long as that obligation existed, the lease obligation existed on February 15th of this year.
In our company, the salaries were above $100,000. We reduced them to $100,000 for 2 months. Are we required to restore them to the levels above 100,000 now in order to qualify for forgiveness?
Phil, that's your area.
Yeah, you're not required to restore those. Once, basically, in any part of these calculations, the cash compensation that exceeds $100,000 on an annualized basis doesn't enter into play anywhere. So yeah, you can cut the salaries of those employees that are over 100, and it doesn't hurt you at all, as long as you keep them at 100 or higher, I should say.
Okay. Is there any adjustment required in regards to the FTE count when people voluntarily quit during the PPP period?
Matt?
The answer is yes. If somebody voluntarily resigns, I think that's an exception item where they get added back to the FTE count, I believe is what it is. They definitely don't hurt you if they voluntarily resign, if they are fired with cause, or if they request a reduction in hours and are granted a reduction in hours.
And Phil, the one thing I would add there is, you know, the requirement with that is that in the case of somebody that you offered a job to and then they didn't take it, it needs to be in writing. some of the bill that the Senate passed would liberalize that. I think it's being recognized that, okay, that's going to be hard to do, to have go back in writing and get something in writing, and maybe something, it'll be liberalized that you won't have to do that.
That's interesting. And one more thing on that, with the written offer to rehire somebody, you know, you made the written offer, they rejected it, so now you don't want to have them account against you. You are also required, on the way things currently stand right now, you're required to notify the state unemployment agency that you did that, and obviously that is going to cause them to stop getting unemployment benefits. So there's certainly a tension there that you'll want to think about before going down that path.
Right, and we do have one listener that commented that the VEC website has a link to report such employees who refuse offer to return to work.
Okay.
Yes.
Lastly, if the employee has been replaced, so one of these people that resigned or was fired, if they've been replaced, you count you include the replaced employee. You can't include that as an exempt employee any longer. So if the person's been replaced for purposes of FTE, you don't get to double count the new person and the old person.
And Cindy, I think we're up against the 3 o'clock hour. Maybe one more question.
Sure, one more question. Do 1099 contractors, are the amounts paid to them, are they eligible for forgiveness?
So that came out in an FAQ a while ago. They're definitely not. So that independent contractor who would presumably be filing their own Schedule C, they would be able to gain a PPP loan on their own, but you would not be able to get forgiveness for monies paid to a 1099 contractor.
Okay. Well, thank you so much for attending our webinar today. You will be receiving an email from us shortly containing an evaluation form and a copy of this presentation along with the slides. If you would like to receive the latest guidance from the SBA and Treasury as it is issued, we encourage you to subscribe to our blog using the link contained on the last slide of the presentation. And if you have any additional questions or need assistance completing your PPP loan forgiveness application, please feel free to reach out to us. And we thank you for joining us this afternoon. Have a great rest of the day.